Good day, everyone. It certainly has been a turbulent few weeks for the bond markets and the equity markets since the 9th of March. And this is especially true for the metals market, or to be more precise, the mining equities that fell quite hard over the past few weeks. The flow of funds out of commodity ETFs has actually been quite dramatic. If you look at this chart, 11 billion was withdrawn over the past 3 weeks, which marks the largest ever recorded monthly withdrawal. And this obviously led to the gold price being off 10% since March the 9th, the silver price 15%, the platinum price 11%, the copper price 4%, and so on. And the result of that, if you can see from the GLD monthly fund flows, the GLD is an index that contains the large cap gold mining shares. The outflows up to Thursday last week was 6.3 billion just in 3 weeks. Now, the GDX index itself is off some 26% from its highs in early March. And the GDXJ, which is the mid-cap and smaller gold index, as well as the silver mining index, is off some 30% over the same time period. Social media, as well as my inbox containing emails from every broker from Australia to Canada, is filled with theories about what really happened in the metals market over the past three weeks. There's a lot of brokers calling for, it's the end of the cycle maybe for gold and silver, especially those that were calling it for many, many months. But our belief is that the sell-off was very much structural in nature, as opposed to any changes to the underlying fundamentals. So what do I mean by that? Well, following the attack on Iran, global financial markets experienced significant volatility, and this resulted in margin calls and forced liquidations, especially on those funds that were leveraged. So investors had to sell everything and they moved into cash, principally the US dollar. Investors were forced to sell assets to cover these margin calls on leveraged portfolio, a factor that actually accelerated the sell-off in both stocks and safe haven assets like gold. The sell-off in gold and silver markets was actually exacerbated by the fact that both COMEX and NYMEX, those are the gold and silver options markets in New York, they significantly increased the initial margin rates since the beginning of the year. Now, we know that late last year we saw soaring gold prices, soaring silver prices, and as a result of that, the options markets increased the margin rates to counter the increased risk in the options market. The flip side to that is that actually it increased selling pressure when prices fell. Early in 2026, the initial margins were set as high as 5% for gold and 9% for silver and platinum. And that's why you saw the greater volatility on the downside in the sell-off in both silver and platinum, as well as palladium. So the real question is, where do we go from here? Now, I think if anyone tells you that they know exactly where the broader markets and the metals markets will go over the next few weeks, I think they're just taking a guess. At best, it's an educated guess. I think the reality is this situation is simply too fluid for us to call properly. But what we do believe is that the rise in geopolitical risk is actually making metals more critical by the day. The UK government published its first UK critical raw material strategy as early as 2022. A year later, in 2023, the EU listed 34 minerals and metals as critical and/or of strategic importance for European society and welfare. And I quote from the document, "These critical raw materials constitute ingredients in key technologies necessary for securing the green transition, digitalization, the space industry, and defense capabilities. They are critical because of their economic importance in relation to the risk of supply interruption, the supply risk." Now, in the US, they had their own with the Department of Interior through the US Geological Survey, which published its final list of critical minerals last year. It outlined 60 minerals vital to the US economy and national security that face potential risk from disrupted supply chains. What we're seeing in front of our eyes today is the risk of disrupted supply chains playing out. For months now, economically sensitive metals such as copper and aluminium have defied logic actually in the face of slower than expected global economic growth. Principally, China has failed to live up to expectations the last couple of years. But both copper and aluminium actually appreciated in price. And this has been mainly due to the strategic accumulation of both metals in both the West and the East. Now, we're reading every day about increases in defense spending, and this really implies an increase in metals demand, as well as inventory build to ensure medium to longer term accessibility of these metals. For example, silver is used in sophisticated guidance chips, used in missiles due to its conductivity in extreme heat conditions. It's reported that each ballistic missile uses between 15 and 500 ounces of silver. Now, we know that for 6 years now, silver has been in supply deficit of around 15%. And that's been bridged by a drawdown of above ground stockpiles of silver. What is very interesting that's taking place right now is that every month over the past 6 months on NYMEX, silver is actually standing for delivery, which is very unusual since contracts are usually simply rolled over into the next month. This month alone, 43 million ounces has physically been delivered. Now, put this in perspective, this is 4% of total annualized demand on a global basis. Most of this metal, and the same applies to gold, is moving into China. The Chinese arbitrage trade, which is the difference in the price that's currently been set in Shanghai and that's been set on NYMEX in New York, is around 12 to 13% or $10 an ounce. Now, this arbitrage has not gone away, which is really peculiar given the gains that can be made by arbitraging this price difference. Metal is clearly moving from Western vaults to China. China reported record imports of silver in February. Yet, we believe that institutional and retail investors are not positioned for any kind of outperformance of commodity stocks over the next 5 to 10 years. If you just simply look at the asset allocation in most of the pension funds around the world today. Now, this is a chart that we've published a few times over the years. Yes, we can argue that the S&P 500 is structurally very different today to what it was in the 1970s and 1980s. But the underperformance since the global financial crisis in 2008 is very stark indeed. But we're starting to see some kind of platform, some kind of bottom being created over the last 8 years. And if anything, that there's been some attempt to start reversing this underperformance. Today, especially after the aggressive sell-off that we've seen in recent weeks, most commodity-related equities are trading at very demanding multiples. Some of the stocks that we run models on are trading at free cash flow yields above 20%. And most of the stocks are trading on EV to EBITDA multiples of 3 to 4, 5 times. This is very undemanding compared to the rest of the marketplace. Now, we'd never say to try and catch a falling knife in the sell-off. We can actually see a scenario where mining equities will sell off even further in the short term, especially if the broader markets were to fall significantly. However, the question you have to ask yourself is, should you have no exposure at all to a sector that's returning to prominence right in front of your eyes and where the relative valuations are extremely enticing? I'll leave it there for today. There's much more that I can share with you if it weren't for time constraints. So please reach out to the MRT sales team if you want to discuss further with either myself or Mark. Thank you.